And we're live.
Live. Welcome everybody to our monthly webinar. Today we are going over personal tax changes, some new stuff that's new this year, and just highlighting some other stuff that is also good to know. So we'll start with some quick introductions. Who is True North Accounting? So True North Accounting consists of Matt and myself, Curtis, and a bunch of other wonderful people that help all our clients. We're a small accounting firm in Bridgeland in Calgary and an office in Okotoks. And
yeah, welcome everybody. I'm Matt. Thanks for coming.
Some of you know us, some of you don't, and yeah, hopefully if you don't, you can. Hopefully, if you're already a client or not, you can learn something valuable today. So you can jump right in.
Yeah, this is our agenda. So this one's all about personal tax. I know there's a lot of strange things this year for the 2020 tax year. There's COVID relief, so we'll touch on some of the ways that government relief is going to be reported on your personal taxes and what to expect when the government starts asking questions about your CERB or your CRB. We'll go through some of that, and then we'll touch on like just some standard tax deductions like medical, donations, what to do with RRSPs, Tfsas, other investments. Not a lot of change with those things, but or like rental properties and sole proprietor income as well. Not a lot of change, but we'll just give a high level overview on how to report that and how it affects your taxes, and then installments, and then some working from home. There's been a lot of people working from home this year, so I'm sure there's questions about that. We'll touch on that, and then just some other little changes here and there throughout the year. And we'll try to get through the slide deck as quick as we can, 30 to 40 minutes, and then there'll be lots of time for questions at the end. So save them up. We're using this program called Crowdcast, which the benefit of this is you can ask questions by using this button at the bottom of your screen called Ask a Question. And you type in that question and other people can vote for it, like vote it up, and we'll answer questions in whichever ones have the most votes, so that we're not getting too specific to one person's scenario. It's more like, yeah, what does the group as a whole want us to address? So yeah, ask your question, type it in that ask a question, and then vote for other ones. We also have some polls at the bottom, some questions. So be sure to vote on the 4 questions we have there. And yeah, you can make comments, say something in the chat on the side. Yeah, and we'll just get started on
Be nice to us this time around. We're right in the heat of tax season, so be gentle on us.
Our brain capacity is not 100%, but is it ever? So, okay, yeah, here we go. Learn what personal tax changes to expect this year and how to capitalize on them. So T4 slips. On the normal T4 slip you get from your employer, or if you have your own business and paid yourself a wage, you get a T4 slip. You'll just notice some extra boxes this year, and those are really like you have to report how much income the employee earned. Well, I guess whoever prepared the slip has to report how much income the employee earned during certain time frames, like March 15th to May 9th, May 10th to July 4th. And that is basically just directly related to the CERB. Some call it CERB, some call it CRB or CURB, and then there's also CRB. So this is just helping the government determine eligibility for the periods that you might have claimed that income. So for CERB, for example, for every 4-week period, you would get $2,000 and you were allowed to earn up to $1,000. So if your T4 slip kind of contradicts that, like says you earned $2,000 in employment income during some of these periods, then you'll get flagged for an audit. And that's kind of how how it's all set up for kind of following up on all this money that they dished out throughout the year.
It's just important to note, we've seen some questions on this already, that it was sort of forced by CRA. CRA did say that all employers preparing these slips have to fill out these boxes. And just know that another like chunk of questions we've been fielding is these boxes alone have no bearing on the tax return itself. It's simply telling CRA what you earned in these chunks of time, but the boxes themselves do not play a factor in the actual tax return filing itself.
Yeah. And if you did receive CERB or CRB or that initial Alberta isolation grant, which is like $1,146 that was available, you'll receive a T4A slip showing that income. And yeah, so that will be reported. It's taxable income. And if you got EI as well, you get a T4E. And for those that might have a sole proprietorship, or basically like if you did have a sole proprietor or a corporation and you got the CEBA loan, that's the 40,000 went up to 60,000. Or if you claim the wage subsidy, that's taxable income, but you report it on your income statement for your business. Now the CERB, so like I mentioned, that's going to be reported on a T4A slip. It's going to be taxable income. They didn't withhold any tax from that CERB payment, so that's $2,000 for a 4-week period, up to, I think the max was 8,000. And yeah, and then the CRB, that's the program that replaced CERB, which went to September 26th, and then CRB came in September 27th, and it's very similar. It's $500 a week or $2,000 for a 4-week period. The difference with the CRB is they did withhold 10% for taxes, and there is a clawback component to it. So as soon as if your other income during 2020 was over 38,000, they start clawing back that CRB at 50 cents. So if you earn more than like 48 grand during 2020, then you just have to pay back all that CRB.
Yeah, they'll ask for it to be repaid. And with the 10% withheld on taxes, it's also like most people, most people are above a 10% tax rate. So if you have these slips, the income gets taxed like any other income. It pools up with your total income and you owe tax on your total income. So with no taxes withheld or with only 10% withheld, it's still going to create, for a lot of people, it's going to create a tax balance owing, or it might just eliminate what they would have otherwise had in a refund too. So there might be some shock when people don't get their return, or when they owe instead of getting a refund this year round.
Mm-hmm. So be prepared. Okay, and if you did get some of this government money, you'll probably receive a letter from the CRA just trying to verify your eligibility, and it'll be one of those brown envelopes that everybody loves seeing. I guess if you receive a refund every year, you love getting that check. But if you're a small business owner, you likely owe. Or you're getting audited. So these ones are just, you could call it an audit, but it's really like a review, like a process review. But yeah, this year, if you typically you'll get one of these if you have a write-off for more than $5,000, like more than $5,000 in donations or moving expenses or tuition, or any deduction. They'll usually just want to see verification. This year it's going to be a little bit higher, a higher number of these letters going out just to verify COVID-related eligibility. So if you do get one, you usually have 30 days to respond, but that's 30 days from the date the CRA writes the letter. So if it's like February 20th, they send it, or that's the date of the letter, you need to respond by March 20th or whatever 30 days later is.
You don't even get it in the mail until couple weeks after, depending when you see it in the mail. So there's usually you got to act pretty quick, and whether it's completely giving them exactly what they want, asking or answering all their questions, or sometimes if it's a little more complex, calling and asking for an extension, you don't want to ignore it. That's for sure.
Yeah, half the battle is just being responsive and being polite. Like, these guys are just CRA agents that are trying to check their boxes, and they want to, they'll probably just ask some questions like, why were you let go? Was it COVID related, is the box they're trying to check. And so some of the things they'll ask for is like that ROE, which explains like why were you let go. And if you're self-employed and you had like business income during those periods, they'll just want to verify that you didn't make more than that $1,000. And so they might look for invoices or bank statements. They might contact the people you were working for, or like your employer if it was employment income. So the more organized you can be and prepared for that, the better. But yeah, you can always let us deal with it, and we can ask for those specific things from you and provide those on your behalf. Okay, Curtis will take over medical expenses.
Yeah, medical expenses. So they've always been a thing. They've always been a tax credit, but something that's often overlooked is the amount. What's actually deductible? There's the type of expenses that are actually deductible is massive. It's an endless list, and CRA even has like a searchable, like a search field where you can type in keywords and search to see. But the important thing to note here that you only deduct medical expenses over and above the minimum threshold, which is either there's a certain amount that changes, it goes up slightly each year, or 3% of your net income. So if there's an example we'll get to on the next slide here that'll kind of break it down. But there's something new this year with medical. Matt, if you'd like to jump back one slide real quick. Cannabis is now an acceptable medical expense as long as it's if you're not buying it off the guy on the street corner, if you've got a receipt for it, it's an eligible medical expense. So we'll say that. Okay, so now to the example of medical expenses. So, there can be a lot of time sorting through all of those tiny little medical receipts, all from various sources. And whether it's us doing it or whether it's you kind of getting organized, getting all your stuff together, it's important to note that sometimes if you start looking at them and they're not even going to get close to the minimum, then there won't be a tax write-off. There's no tax credit for it, and you don't even need to include them. So this example, say you pay $1,200 for your Blue Cross annually, and then you have another $2,100 in other medical expenses. So you total out of pocket $3,300, net income of $80,000. So we see like 3% of $80,000 is $2,400, right around the minimum threshold, right? So of your $3,300 minus that minimum, only $903 becomes a tax credit, which in Alberta saves you 25% of that as tax. Now, if you start going through, if you look and you're like, oh, well, my net income's 80,000, so 3%, 2,400, and you start adding up your receipts and it's like you're struggling to get to half of that, then sometimes it's just don't waste your time trying to scrounge up the rest of them if you know you're not even going to reach the minimum because all your work was for nothing. So key point there for medical.
And if you have a health spending account or benefits that pay for most of your prescriptions and dental and all that, and you're not paying a lot, like you can't claim the full amount if you were reimbursed. So it's just the out-of-pocket amount that you can add to what you paid for Blue Cross or whatever. So it's not the full amount of the prescription or procedure, it's what you had to pay out of pocket.
And medical premium, the actual premium for the plan is part of it. It is deductible. So that's another thing that people often miss is just the actual premium they paid.
Okay.
Donations, another constant when it comes to tax write-offs. So in Alberta, we can get back up to 50% of our donations for amounts over $200. 25% on the first 200, 50% on anything over 200. So donations, a couple key points with them that again often overlooked. It has to be like a registered charity. So you're gonna when you donate to a registered charity, you're gonna get an official tax receipt. We have a wonderful example here that we've found and included. On that receipt, you're gonna see that it's signed. There's a year, it's dated, the amount. It shows the registered charity's number. There's a bunch of things that have to be on there for it to be acceptable, for it to pass like a CRA review. Ones that are often like where the mistakes get made, or where you include or try and find things that might not be acceptable, are things like the STARS lottery, those hospital lotteries. Those type of items, they don't count as an actual charitable donation just because you're getting something back in return, that chance to win the lottery. So it's those ones are win-win because you got a chance and you're donating to a good cause, but you don't get the tax credit for it. So new this year on donations, there's registered journalism organizations that now qualify for charitable donations.
And just to note, with donation receipts and medical receipts, like if we're doing your taxes, we like to see the actual receipts so we can scan them in. And when you, like if you do ever get audited, we can just address it and send in the scanned copies of those donation receipts and medical receipts on your behalf. Half the time you don't even really need to know about it. And so we really have a policy like, we won't write it off unless we have the actual receipts from you. Like a letter or an email sometimes doesn't cut it. You got to have that signature on here and like official receipt for income tax purposes. So that's really what it comes down to, is having that official tax receipt. Okay, Rrsps and Tfsas, we'll just touch on this briefly. So registered retirement savings plan is, well, you all know it's just a way to save for retirement. And when you put money into your RRSP account and invest it, you get a tax savings this year. Like it's helping you reduce your taxable income and either reducing the tax you owe or increasing your refund. So you got to have, we need the RRSP contribution slip to make sure that it's going to the right year and it's in the right person's name. We don't want to, like there's very specific rules around your RRSP. You can't, like spousal contributions are treated very differently, and you do not want to go over that contribution limit. Everybody gets, if you have earned income, you get an additional, like 18% of your earned income increases your RRSP contribution limit. And if you contribute more than you are allowed to, it's years of pain and like very complicated penalties to fix it. So be careful when you're investing in your RRSPs. Don't go over your limit. Tfsa also has similar rules, but Tfsa, the main difference from RRSP is it doesn't save you any tax today. So you don't get that tax savings today, but any growth, any dividends, anytime you withdraw cash from that account, it's tax-free. So that's the main, like it's a very attractive and good vehicle for saving for retirement, especially if you have a bunch of growth stocks and then you convert them to dividend paying stocks. That can be huge during retirement, having tax-free dividends or interest. Right now, Tfsa is being added $6,000 per year, no matter who you are, like for every adult Canadian. And yeah, if you were of age from when this plan was first started by Harper back in 2009, you can invest up to $75,500 in your Tfsa.
And if you do withdraw, you get that room back the following year.
If you put it back, like if you withdraw, then you can reinvest, put the money back in, but you have to wait till the following year.
Other notes on investments. So unregistered accounts, so not an RRSP, not a Tfsa, unregistered account. You always want to make sure you're getting a statement of realized gains, losses from the financial institutions. Some banks and other like investment firms will spit them out automatically within your package. But if you don't get one, ask for one, because that's can be a point that gets missed. If you sold something earlier in the year and you forgot about it, any gains or losses have to be reported. So you're also going to get a package with your T5s, your T3s, your T5008s, which T5008s are the reporting of gains and losses, but they're prone to error from the financial institutions. So it's always good to get that statement of gains and losses. And another tip, investment management fees. So any fees paid for someone to manage your investments, that's a deduction that can be claimed as well. Foreign investors.
I just want to make a point. Like when you get this package, like say you're with RBC or something, the investment fees can be reported a couple different spots. Like on a per transaction basis, you can have like $9.99 or whatever. But there's usually one line that just says total management fees for the year, like 4,563. You just got to look for that total amount. Yeah, so you might just have to search through all that paperwork to find that.
Investment fees on registered do not count as a deduction, unfortunately. But yeah. If you see them, make sure to highlight them or circle them or note them and get them to us, because they help. Foreign investments. So every year, the question's been on the tax return for as long as I can remember. It's always been there as far as I know. But you have to indicate to CRA if you own foreign property worth over $100,000. And so this foreign property, foreign investments, foreign real property, if you have to report. The government wants to know if there's money outside of the country. Now, it does not include a personal use property. So if you've got a home or a vacation property that you're not earning any income from, you don't need to report that if it's worth over 100,000.
What if it's not net income? Like, so you rent it out for a little bit, but you don't actually make any taxable net income.
If it's gross, if it's generating gross revenue, then it needs to be, you have to tick off that box that, yes, I do own foreign property over 100,000. If it's strictly personal use, you're not earning anything from it, you can still tick that box, no. And then one other quick note, if it's over 250,000, there's greater detail in what has to be provided to CRA. So often if you're going to be getting extra statements and reports from an investment or from your financial institution that gives the details for what you sort of have to fill out on that T1135 form to report the foreign property over 100,000.
Okay. Okay, we just wanted to touch on rental properties in case anyone out there is a new landlord this year. So rental income, you do need to report on, it's called a 776 or a T776. And this is the template that we send to our clients in our checklist. If you've received our email checklist with all the stuff we need for your taxes, this is under the rental property section. And yeah, it's just put in your gross rents for each month. If you had any vacancy, just amount paid during the year. And then you can deduct. The first one, there's interest on mortgage per statement. So your whole mortgage payment for that rental property is not a deduction. You have to actually go to your mortgage statement, which should be mailed out in January every year, or you can probably find it on your online banking if your mortgage is with your bank. And it'll break down, like say your mortgage payment was $2,000 a month, so $24,000 in a year, maybe $11,500 of that was interest and the rest was principal like, yeah, you're paying down the principal on your mortgage. That principal payment is not a deduction. It's basically your taxable income portion. But yeah, you can deduct your insurance on that property, your property tax, repairs and maintenance. If you had to get cleaners in there between renters, anything like that, you can deduct that. If you had to hire a handyman or a plumber, get new appliances, is kind of like it depends how much you paid. If it's under $1,000, yeah, expense it. And if you paid the 26 or 31 bucks on Rent Fast or whatever it is now, or like had a paid Kijiji ad, you can write that off. Obviously, if you're paying the utilities, you can deduct that. Condo fees, bank fees. Some questions you get, like, can you deduct mileage? And generally, no. If you have a portfolio of rental properties, like more than 3, you can deduct some mileage, and maybe some cell phone. But yeah, for the average landlord that has one or 2 properties, no mileage. And yeah, just the net revenue or the net income from that rental property is added to your taxable income. Which, the one shock that a lot of new landlords experience is you can lose money on your rental property, like it's costing you 200 bucks a month, and then you still have to pay tax because you paid down 10,000 on your mortgage. So there's that piece that can kind of be unpleasant news for some people. And sole proprietors. So there's another form called Statement of Business Activities and it's the T2125 form. This is where you report business income from your sole proprietorship or partnership even. And yeah, it's basically just your income statement. How much did you make? What were all your expenses? There's a spot for home office expenses, vehicle expenses, and then you're taxed on the net income. It pays CPP on that net income. If you do have sole proprietor income, you do have a bit of a filing extension. You don't have to file till June 15th. However, if you owed tax, it's still due to be paid by April 30th. One thing I just thought I'd put in here is just to note that GST, like if you're a sole proprietor with GST, the GST is a completely separate tax filing. So it doesn't get filed when you do your personal taxes. So you can go onto your CRA My account or your My Business account and file your GST return there. It's got the same deadlines as your personal tax return. If there's tax owing, it's due April 30th, but you actually have till June 15th to file. And so most tax deadlines, there's usually 2, a filing and a payment. So if you miss a filing deadline, you get dinged with a penalty, which is usually 10% of what was owing. And if you miss a payment deadline, that you start incurring interest until you pay that amount. So if it's like a 5% interest rate and you're 2 weeks late filing, your interest rate will be like, I don't know, 0.01% or whatever. So the interest isn't going to be a huge portion of it if you're only 2 weeks late, but that penalty will still be 10%. So that's the one you want to avoid.
And CRA's interest rate is up to 5% now. It was sitting at 3%, and then for the longest time, then 4%, now 5%. So you can tell the government needs the extra dollars.
And that interest rate is applicable to installments as well. So if you had to make installments for 2020 and you did not make them, you're currently incurring interest from the payment date. So the payment dates are the 15th of March, June, September, December. If you just ignored your installments, yeah, you'll be accruing 5% from each of those dates. And then if you pay your taxes April 30th and you owe at least as much as the total installments were, like say you had to make $1,000 installments for a total of $4,000 and you owed at least $4,000, yeah, you would have some interest that you have to pay from March 15th to the date you paid, and then from June 15th to the date you paid, September, and so forth. So yeah, that's just, if you ever see that little adjustment on your notice of assessment, it's from unpaid installments.
And installments is, we talk about it so often because it's way more confusing. The CRAs never explains it that well. And Lisa's posted a link to our blog that sort of breaks it down a little better. But if you're not familiar with it at all, it's essentially the CRA seeing that you owed over $3,000 last year, and so they want that paid, and then they also want you to prepay towards next year because they think you're going to owe a lot again. And there's no one way or the other. They either ask for it or they don't, and there's no like it would be much easier if they were like, oh, you have always paid your tax on time and never been non-compliant, so you don't have to. But that doesn't exist. They request them and they will charge you interest. You don't pay them and you end up owing again. So there are not a lot of, nobody really likes installments, but it's one of the things we just have to abide by CRA's rules. It's a lot easier to just make them and move on.
Yeah, and the easiest way to do that is when you're done your taxes right now and you see installments for 2021, just schedule those. Like you can go in your online banking and you can schedule a payment for June 15th and then do another one for September 15th and another one for December. And yeah, as long as you're confident cash will be in your bank account, yeah, you won't have to incur any of those penalties.
And if you get your tax return from us, you'll see that schedule of installments. If it exists, it's right on the front page. So you can't miss it unless you try really hard.
Yeah.
Working from home. So this is one of the new ones that we've seen more than anything. Questions on it. There's been a lot of articles that you might have seen online about it, but there's a new temporary flat rate. So if you had to work from home and it was due to COVID, so if it was COVID related and you moved to a working from home environment, there's a easy method to doing this. And it's simply $2 a day up to $400 as a tax deduction. So a direct deduction against your income, which is a big, it still saves, it all adds up, right? Every dollar back on your taxes is a positive thing. So this one, they made it super easy because they knew a lot of people were going to be affected by it. And you simply have to enter in the number of days that you work number of working days you work from home, and no extra support is needed as far as receipts for expenses, other like, so it's if you worked from home for more than 50% of the time during at least one 4-week consecutive week period, then you qualify. So if there was a chunk of time you were working from a home office and you don't normally do, then you can just very easily tick off the box and fill in the number of days and get that sort of easy simplified credit. There's a more detailed one as well, and there's always been this in the bottom section. You see the T2200. That's always been a thing. It's always been a form where you get it from your employer, and it says that, hey, I have to pay expenses in relation to my employment income. And there's plenty of things it could be. Maybe you travel for work, you have to entertain people. There can be a variety of things, or working from home. But there's a new one for COVID-related expenses working from home. It's the T2200S. So again, this has to come from your employer. It has to be signed. It's a standard, very, very simple form. It's essentially one page signing off by the employer saying, yes, this employee had to incur expenses working from home. And in that case, you can go up over and above the $400 deduction if you had much more expenses. So if you had a dedicated room, that's a percentage of your house, there's utilities. If you're paying rent at your home, that can actually be put in there. General office supplies, stationery. There's a few things. Their list of expenses that can or cannot be included is rather strange. There's some ones I don't necessarily agree with, like buying a monitor, a computer chair,
webcam, headset.
The things you'd automatically have to go get if you just abruptly got moved to working from home, they don't count those, which is kind of strange. But I guess in their view, it's, well, you're going to get to keep these improvements or these better products when you're done working from home. I'm not sure exactly why they don't, but there still is. If you had to work from home and you did have like quite a bit of work from home, there is a more detailed method to get over and above that 400. So just make sure you get the signed T2200S, because CRA is well, will likely may ask for it, and you need to have it on hand. So
yeah.
Couple new things again for this year. So the other section, there's a brand new one, digital news subscription expenses. So there's up to a $500 tax credit to be claimed if you paid for, there's a qualifying subscription. So essentially if you purchase online, sort of a newspaper subscription from Canadian media outlet, but like in electronic format, there's a tax credit for that. Home buyers.
Trudeau's best friend is the media, so he's just doing them a solid back.
Yeah. If you go spend money to the media, he will give you a tiny tax credit in favor. So home buyers plan. So this has been around for a long time as well, but the change this year is the maximum you can withdrawal, Matt, is up to $35,000 now. So when it's going to be your first time buying a home, you can pull money out of your RSPs to use as the down payment, and you don't get taxed on that RSP withdrawal like you normally would. And so that used to be 25, it's now up to 35,000, and double that for couples. If you're not considered first-time home buyer, you experience a breakdown in marriage common law, you may be able to participate again. So it would be you getting your first one in a different scenario there. So they up the limit because they know how high home prices are getting. So I guess that's a good thing.
And everywhere but Alberta.
Yeah.
Okay. Yeah, keep going.
Yeah, student moving expenses. So moving expenses, again, they've been around for forever, but there's also qualified. You're qualified to deduct expenses incurred if you have to move at least 40 kilometers to attend post-secondary education or an institution, so a college, a university. Deduction can be made either against taxable scholarships or income that you've earned elsewhere while at that new location, new school. Canadian training credit, another small one, but it's there, it's cumulative. They announced it as new in 2020, but it actually applied back to 2019. And so some people have an opening $250 a year credit to use. And this will show up, you'll see it on your notice of assessment. You can actually ask to use it in the year or carry it forward. So any eligible tuition or like even like course fees, if you take an exam for some kind of training, if you have those type of expenses that you claim on your tax return, you get this $250 credit, and it adds up to a lifetime. You can accumulate up to $5,000 worth of these credits. So it just may be something where, hey, I'm going to keep accumulating these and save them and use them in a year where I have higher income. So, but it is a new one this year. We wanted to throw it at you.
Yeah, to help people reskill or retrain for the change in the job market. Okay, 4:39. We are right on time. A minute ahead of time. Okay, so we'll hit the questions here. There's some good ones for Curtis here. Okay.
What do we got?
Let's vote. If anybody has a question they haven't asked, put it in there. We only have 4. But yeah, we'll start with investment fees.
So for unregistered account, not for TFSA. So you mentioned fees for buying stocks. Example, the $6.99 every time you buy or sell it are deductible, but it's only for unregistered. TFSA, anything that happens within that is not taxable, and there's on the just like a gain on a sale would not be taxable, a loss would not be taxable or deductible, and these fees are not deductible either.
Yeah, that's a good point. So if you're buying investments in your TFSA, it can like, yeah, if it's like a penny stock where you could get 1,000% returns, that seems great. That like, oh, that would be taxable. But on the other side, if it is a big capital loss or you lose everything, you don't get to use that loss against other gains. Okay, another one for you, Curtis.
What if you paid yourself in T5, so a dividend, and claimed CERB? How would that affect them determining your eligibility? So this, I don't think I'll be able to give you a direct answer without knowing more. You might have to reach out for a little more info, but I've had similar conversations very frequently over the last little while, just because of the uncertainty. Nobody really knows. CRA hasn't really announced how they're going to review this. A dividend is from your own company, is issued at a point in time. So technically, you're saying, I am declaring a dividend of $20,000 as of December 31st, 2020. So you'll show that you have $20,000 of income on a T5 on your personal taxes. And then CRA might also see, hey, this person also got CERB for 2 periods way back when. So maybe they send the letter, maybe you get a phone call or the brown envelope and they say, hey, we just want to confirm when you actually took this cash. And maybe it's as simple as an explanation. Maybe it's some bank statements to show that, hey, no, I paid this all in one lump sum or took it out near the end of the year and it wasn't. What matters is that you weren't actually taking the cash at the same time that you were drawing from your company, because that should technically put you offside, right? So again, if it was CRB, then it's like, well, maybe you drew a dividend at the end, but that bumped you up over the 38,000 limit. Now you've got clawback. So there's a lot of what ifs in this scenario, and like when did you pay yourself? How did you declare it? When's the company's year end? Did you have T4 income at the same time? So this, and couple that with the fact that we don't really know when or how intensely CRA is going to come looking at these. They're probably going to immediately go to the T4 people that have those extra boxes filled in that says they earned income at the exact same time, because those are like the easy pickings for CRA to go after. And then maybe if they see a dividend to yourself that's the same as it's very like comparable to prior years, maybe they're like, hey, let's go look at this guy because it looks like maybe he was drawing at the same time. So unfortunately, we don't know how they're going to look at it, but proof of when you actually took funds is likely going to be the fallback, that sort of the deciding factor.
So maybe
a big complicated maybe, a niggly maybe.
And so, Curtis, what would you say about $100,000 property that's co-owned by a husband and wife?
So I'd say I'd tick off the no box here. Technically, you're each answering this question on the tax return individually, and you're saying that no, you do not own property, and so your portion of the cost of that property is less than 100. I'd be comfortable ticking off the no in there. If it's 200, then well, yeah, it's you're both going to be saying yes, but no, you own, just like if you went in with me on an international property, you're answering for yourself, and you don't own a property that's worth 100 because I own the other 50. So it's the same as a taxpayer. Do you own more than 100? And the answer would be no, you own 50.
Beauty. Okay, Tim's wondering, if you live in your condo and have a roommate renting a room, do you have to claim that as rental income?
That's a funny one, because if it was a CRA agent that was answering the question, they'd say, yes, you have to report your income from all sources in Canada. And then they'd start lecturing you on what expenses you could claim against it. So if somebody's sleeping in, if you got a roommate staying in a room, you rented out the house or that room because you weren't using it, and you're getting $300-$500 a month, you do have rental income to claim. But then that means you're also able to claim rental expenses, which would be what portion of the home that room takes up, applied to all sorts of things, right? Utilities, property taxes, home insurance, mortgage interest, things like that. So you do technically have a rental schedule on your hands. But the funny part of that is this is often one of those things that gets overlooked, and it sort of doesn't get talked about. And there's no, it's not like an entire house where it's very easy to see that you own it and you don't live in it and you get rental income from it. So it's not as clear cut.
Yeah, if you wouldn't owe tax on that rental income, you don't have to report it. So I guess that would be one thing to look at. Like if it's going to be a loss or break even, then it's up to you. If you want to report it, that's fine. If it's a family member, or if your roommate is not arm's length, that's also kind of optional. Probably better just to keep it off in that case. Yeah, so that.
Yeah, rental income from family members or friends. If you're giving them a deal, then you actually, CRA says you don't claim that as rental, like a rental income and expense schedule, because you could be, in CRA's eyes, they're saying, okay, well, you might just be creating a rental loss by giving your brother a discount on this room rent. So they just say if it's not like an unrelated party, then just don't even report it.
Bingo. Okay.
Matt,
next one.
There's a good one for you. This is a complicated one, Wendy, the follow-up question. So with regards to that international property, is there a special way that we need to have it set up? Is it necessary to have family trust, or especially right now, U.S. tax situation, being nervous on property down there, but not wanting to give it up? I don't know. I don't know if a family trust is going to be the answer. There's nothing wrong with just reporting it as owning foreign property. If you report as Canadian tax resident, you report your worldwide income, and Canada has tax treaties with all sorts of countries where they avoid double taxation. So the thing is, CRA, the Canadian government, just wants you to report it. There's other spots on the tax return that if you're earning income from it, you're going to report that, but they just want to know that you do own foreign property. And
if you do have rental income on that place, there's rules, like at least in California, like the tenant, if they know they're paying it to a Canadian, they should be withholding 25% until that landlord files U.S. tax. And then after you file a U.S. tax return, we can enter that investment or that like property income on your Canadian tax return, but you get credit for any tax paid in the U.S.
Yeah. So having it ownership of the rental property in a family trust, I think that goes a little bit beyond the scope of what we're covering today, and the amount of extra detail we'd probably need to give any proper advice on that would be, we need a lot more info.
Yeah, and I just see this note down, or the comment, it's solely personal use, then you don't have to claim it. If it's personal use and you don't generate income, you don't have to report that. It's not an investment. It's not like well, in that case, it's a liability, really. If you depends how you look at it. It's not an asset because it's taking money out of your pocket, and you don't have to report foreign liabilities.
Yeah. So jumping back to that section when we talked about it, if it's solely personal use, you can say no. You do not own foreign property over 100,000, because that's one of the exemptions. You don't have to say yes if it's just personal use.
Yep. Okay, last one. When claiming business expenses for a sole proprietor, should the totals you're claiming include GST or not?
Not.
Kurt?
So you're gonna, if your GST, I guess I should preface this. If you're GST registered, so if you file a GST return, then you're gonna fill out the sole proprietor, the 2125 form. You're gonna fill that out with your gross income without GST, and your expenses are gonna be without GST, because your GST gets handled separately on the separate GST return. If you're not GST registered, so you're not collecting GST and you don't have a GST return, then you do the full total, expenses without or with GST. So you get that the GST you paid becomes part of the expense in that case if you're not GST registered.
Yeah, cash in, cash out.
Yeah.
Okay, well, that is everything. Thank you so much for everybody.
This might be the first one where we weren't pushing right up against the limit, but I guess everybody has their personal taxes under wrap, and we can call it an end to tax season this early. Is that what you're saying, Matt?
Yeah, sure. So I'll take a 4-day weekend. And yeah, if you haven't answered the poll yet, we have some results. Did you know that CRA withheld 10% of CRB? Most of the people had no clue that that was the case. And most people do not pay their personal tax installments.
Or do they pay personal in general? That's how I read it.
Do you pay personal tax installments? Yeah. So if you had self-employment income or something, you're more likely to have installments or rental income. Do you have any interest or penalties on your personal tax return? No. Did you work from home?
Awesome. Yeah, yes. See that? Yeah, that home office tax credit's going to apply to a lot of people this year. So it's a really easy one. $400 deductions, pretty easy, and there's gotta be quite a few expenses to get up to that point, anyways. So good. I'm working from home too. Matt, can True North Accounting get me a T2200S, please?
Sure. Write it up. Write it up. I'll sign it.
Yeah.
Okay. Thanks, everybody.
Thanks for coming.
We will wrap this up. We'll see you next month. Thanks for coming. And